Greetings, Dale. Welcome to the show.
Thank you. Hi.
Hi. So, thanks again for coming onto the show. I just want to quickly introduce you to the audience. So, Dale is a trader here in Montreal and has had a long time career in trading. And I'll let let Dale tell his story a little bit further in a few moments. But why I invited Dale to talk to us today is because he just recently presented at our Montreal Traders meetup just last week, and he gave a fantastic presentation on quantitative trading and shared his perspective on system design and just his experiences building systems. So Dale, really look forward to exploring this topic further and hearing more about your trading journey. So thanks once again for coming on the show.
Well, thanks for inviting me, Jason. I really appreciated speaking last week. It was a lot of fun.
You bet, man. People loved your presentation. So why don't we start from the top? Why don't you share with the audience maybe your trading story? Tell us, you've been trading for a while. Tell us how you got started, and we'll go from there.
Sure. I would say my journey started, I was thinking about this morning about 20 years ago, in 1998. I had a summer job in Calgary, and that was my first exposure to the oil and gas sector. And that was when oil was in the low teens.
Yeah.
And so the people around me were working in either in the oil and gas sector or in the trading business, so in financial services. And so I was exposed to it a lot. And what happened was I was at the end of my my university studies, and that experience really shifted the focus of my last 8 months of my school, of my studies. So I completely focused my thesis onto option pricing. I did a course on time series analysis. I applied it to stock market, returns, these sorts of things. And that got me going. And then from that experience, then I got my first job on a trading floor in Calgary the following year, so 1999. And so I started, which is sort of the classic way as an analyst, so doing fundamental analysis of electricity and gas markets. And so that was my first foray into trading. It was very intimidating at first. The days started very early because we were trading New York hours in Calgary. So we had a fundamental meeting at 7 a.m. So we had to be in the office by 6. And so I'm running models, doing all these things, and I had to give a presentation to traders every morning at 7 a.m. And that was, it was quite intense. And then from there, I was young and I guess maybe overly ambitious, and I wanted to do different things. And so I switched from trading into consulting, so still as an analyst. And during this whole period of time, my roommate was a stockbroker. So like the classic, before, online brokerages, when we had these classic brokerage accounts where you had to phone in your orders.
Phone in your orders, sure.
So and of course this was during the .com boom, and so we had so one of the first things I did when I moved to Calgary was open a trading account with him, of course.
Okay.
And so we were in on these IPOs, and at the time the big thing was the JCP markets, so the predecessor to today's venture exchange.
Right.
They call ECPs now, like kind of like an IPO but for very small capital pools.
Yeah.
And so we were active on those, and so that was sort of my sideline was trading equities, and then my day job was in the commodity markets.
So you had that side hustle going, making some extra cash on the side, sure.
And then
how long? Yeah, go ahead, keep going.
Sorry. Then from there, by 2001, I got an itch and I wanted to go abroad to work. And at the time, the electricity and power markets were deregulating in Europe. And so I had this whole baggage of experience with fundamental modeling for power and gas markets in North America, where things had been very, let's say, ahead of their time. And this was around the same time that Enron was the wheels were starting to come off of Enron. And so I also I didn't know it with perfect hindsight. I can say it now, but I mean, at the time, there was a bit of a gut feeling that things were not all right. And so actually I was glad to get that job in Europe because in the year after I left Calgary, a lot of my friends were laid off and had to switch companies. These sorts of things had happened. And so during that period of time, I put the brakes on trading. I was not as active on trading. I considered myself more of an investor. I think the thing was, when I was a consultant, we were seeing a lot of the projects going on in the oil and gas sector in the oil sands. And so I had a pretty good fundamental view of what was going on there. And so I just invested in a lot of oil and gas stocks in that time. It was very, very much long-term holding periods. And then I would say progressively from 2002 to 2005, I tried on a number of different occasions to get back into trading, wasn't able to get a job. And then finally by 2005, the stars were aligned and I got back onto a trading floor in Europe. And that's where I stayed so I was on that trading floor for 11 years until 2016. And over that period of time, I covered 3 different product groups. So structured products trading. So I was more on the option pricing and kind of more bespoke products. Okay. And then onto cross commodity trading, which was spread trading, basically finding relationships between different commodities and trading on that basis. Okay. And then lastly, coal, so financial coal swaps.
Interesting. Yeah. So, a couple of questions come to my mind I'm curious about. So you mentioned that the wheels fell off of that whole Enron train. What was the blowback there? So when Enron did fall apart, how come people ended up losing their jobs there? What was the blowback from that whole debacle when Enron kind of folded?
I think the principal thing that happened was that with Enron gone, they were a massive liquidity provider in a lot of these markets. And the problem with power and gas markets at the time, aside from Henry Hub, a lot of these smaller hubs and locations needed liquidity to keep those markets going, because the incumbent utilities were not in a trading mindset. Right? They're more in a production mindset. I produce electricity, I sell it onto the grid. And Enron had this approach where we are buyers and sellers at any given time. We make markets, right? That was one of their mottos. And when they fell away, some of the larger players, then there was a couple things that happened at the same time. There was an overbuild of power plants in the U.S. So a lot of the utilities or trading houses like Duke, Dynegy, these guys were also invested in these power plants at the same time. And so they had cash flow issues related to that as well. And so their trading appetite reduced as well. As luck had it, where I moved to in Europe, there was not that issue. I mean, Enron hit Europe as well. The company that I work for, we hired 2 or 3 traders from ex-Enron traders during that same period of time. And but we absorbed that and things just kept going. I think that was the big difference.
Yeah, I think Enron was well famed to have a huge trading desk.
And they had this reputation in the market of that they could do no wrong.
That's right. They had this amazing quarter after quarter, year after year. It was like perfect financials every single year until it wasn't, right? Yeah, what a crazy story. So folks who never, maybe have not read up on Enron or don't know much about trading desks in energy companies, what does that kind of look like? What do they do? Are they like, I know it's kind of an exception because they were making markets as well, but would you typically say that these trading companies or these energy companies are trading desks? They're hedging themselves, or are they actually using trading as a means of making revenue as well, speculate and earn revenue?
Yeah, there's definitely. I would say that there's there's 3 pillars to trading in these commodity firms. Okay. So the first is the obvious hedging flow that happens. So you have a power plant. You need to sell power. You need to buy gas to put into the power plant to burn. Yeah. So those are kind of these classic flows. You have external customer flows. That's the second pillar, which is more related to, it could be clients that you don't even have power plants in that market, but you're providing like retail services for in another market. For example, you want to make inroads into the French power market or the Dutch power market. You have no power plants there, but you're buying wholesale power and packaging it on to retail or industrial clients. And then the third is, and that depends on the appetite of the company, but there's definitely a proprietary trading activity in a lot of these firms. And my view of it is that it's not so much speculative as it is information gathering. I think what companies value is and that's something that I really felt appreciated as a trader, bringing market information to the company.
Okay.
So we're seeing things much faster than senior management, right? We see trends happening. I mean, I remember during the 2008 crisis, we saw Lehman. I took a loss on Lehman Brothers instantly, right? Very quick. Yeah. Because all of a sudden, from one day to the next, they're not there to pay the bills. So
right. Yeah. And so the trading desk, though, if they are speculating, then they're not considered a cost center. They still have to make money, and obviously they have to turn a profit, which is not that.
Yeah, definitely. Yeah, that's certainly. I mean, there's a profitability, and I think the thing is, if I look at over those years, I've seen some spectacular blow-ups, not in so much internally, but in the marketplace. Yeah. Because it's an OTC market. Right. In a lot of cases, we see the counterparties, and so you see company X is buying a lot. Yeah. You know that they're long, or they've been covering a massive short, one way or the other. Yeah. And so that information gets out into the market, of course. Right. That's definitely I find trading is has more of a personal element to it in those markets. You know who's on the other side of the trade. Yeah. And so your job then, if you know that, is to squeeze that other person. Have you been on that side? You're purposely going after that other side party, knowing, these guys are probably trapped, and our job is to kind of stick it to them. Yeah. There's definitely reading. Interesting enough, I'd say that I think that the biggest blow-ups I've seen over the last 10 years have to do with the own person's ego. And they tend to corner themselves into a market, and all of a sudden liquidity dries up and they can't get up. Yeah. And they've taken a big bet on one side of the market, and at some point the market figures that out and it gets ugly. And you mentioned you traded kind of three different types of products. Some of them are OTC and some of them are on an exchange. Yeah. What is kind of the difference? Like most retail traders, I never traded OTC because they just don't have the counterparties. What's that like? What's it like trading OTC versus trading on a regular exchange? I find that on an exchange, you are your order types, everything is very mechanical. Since I've switched to that system now, it's much easier for me to deal, not to make money, but to deal in markets. Yeah. The OTC markets, generally speaking, at least the ones that I dealt in, are a combination of voice and screen. Okay. And so the screen that you see is not it's not an exchange screen, but it's an aggregation of different broker screens. And so we had a platform that would aggregate these prices into one common set of bids and offers. Yeah. But in between those prices, there's voice markets all the time, especially in liquid products. And that's where understanding your broker, how they're working your orders, it gets very nuanced at times. And I find it hard to manage. So on one hand, you have your position that you want to manage and you want to do the right thing. But on the other hand, the day-to-day physical activity of trading can be very overwhelming sometimes. Yeah. Yeah, I can imagine that. Imagine if you're trading OTC and you have kind of that squawk box and there's a bunch of voices going on and you're trying to track these different markets. It must take time to kind of get used to that kind of information flow. Yeah, exactly. And it's very interesting to see the waves of how it works too. Because a lot of times the commodity complex, energy complex just gets attached to the oil price. Right. And so of course the oil price is the one that moves the fastest. So we'd be sitting there. So when the Department of Energy statistics, when they come out on Wednesdays, it's late afternoon for us in Europe. And that's just a big event. I mean,
right. Yeah.
It's
game time, right?
The broker screen, the squawk box lights up, and you've got brokers shouting all kinds of different things, and people are just reacting on movements of oil price, which have nothing to do with the other commodities, but at least temporarily there's a perception of that.
Yeah. And so, having traded, on that trade desk and the institutional side, what's typically for a person who's, more on the retail side and has never been exposed to that, is there usually like a training program that people usually go through, or is there some sort of mentoring that happens to make sure that, all right, you don't just get on the desk and, learn by failing? Is there a way that people, that these companies tend to, cultivate their employees so that they're not just throwing money at them? And
definitely. There is a senior junior mentorship that happened in our company.
Okay.
So I was on the desk already for 3 years, and when I switched desks, I was still put under a senior trader.
Yeah. Okay.
To keep an eye on me, make sure I'm, and I was in that role later on, and you're always, making sure, check your deals, all these sort of basic things you need to make sure that the brokers, you've done this, you've done that. You kind of have a checklist at the end of the day to make sure that your positions are square. That so there's definitely it's more, I would say it's more of a mentorship.
Okay.
That happens. You do have to do, of course, the regulatory requirements, but that's just the basics, right? You don't do anything there.
Yeah.
But definitely there's a mentorship that happens kind of informally, but it's super strong though. It's very strong. You gain a lot of respect for senior traders.
Yeah. Yeah. Unfortunately, I think that's something a lot of retail traders miss out on, right? Because they don't have that guidance from someone who's kind of been there and kind of been in had the battles and that kind of stuff, and you can learn from someone a little more seniored. Versus just going off and trying to figure it out on your own, which unfortunately is a very, very tough way of doing things.
Absolutely.
Yeah. So let's keep going. So you're working at at a European firm. Now transition us to where you are nowadays. So I know nowadays you kind of shifted a bit. You changed your style of trading. Talk us through, what kind of was the catalyst for you to change, and what are you doing nowadays?
So that for me was in 2016. So as a family, we decided we wanted to move back to Canada. And I think at that point in time, I needed some sort of new challenge with my trading. Not that I was, I don't know. I mean, there's always challenges, of course, but I wanted to do something, something different, let's say.
Okay.
And so the first thing I did was I just took a break. So late 16, early 2017, I didn't look at markets really. And then but at the same time, I knew that I needed to work on things like basic programming skills. I always have been implicitly throughout my years in trading, I'd always been doing modeling, but very ad hoc. I was just building. Usually it would be an Excel model, and if it was getting too slow, I would program it. It was more I would program out of laziness than any sort of real genuine interest.
Okay. That's always a good motivator, right? How can I save some time?
I just need to automate this and make it go away.
Right.
And so then what happened was, so during the course of 2017, I took some online courses in programming, Java, Python, these sorts of things. And towards the end of the year, I was getting a bit bored with that because I'm just doing these exercises over and over again. And I get the hang of it, but I need an application. And so around this time last year, I'd mentioned this in last week's meetup, I got back to reading, finally got to reading Reminiscence of a Stock Operator.
Yeah.
And that book is just incredible how it really... it puts you into the emotions of what the guy's going through. It puts you through walks you through a lot of things that are timeless, really. Yeah. It's an old book, but it's very timeless. And that kind of gave me a bit of an itch to get back into it again. And so at the start of this year, I started applying what I learned with Python, and not so much Java, but more on the Python side, getting some data sets in, starting to do some analysis. Let's see, you know, can I build up a model from scratch? And that was sort of my challenge. And so over the course of this year, I think the thing was what I realized being in that OTC environment is that because you're interacting with brokers a lot, it's a very social activity. You're right. Checking prices all the time. You're always, there's an emotional element, unfortunately, to the trading that comes through, because if you didn't get filled, it's because your broker didn't get you done.
Yeah.
And, you know, you're angry, you know, I was bid on screen, why didn't you get me done? And you know, these sorts of things. And so there's this element of emotions that I wanted to take out of the trading, and knowing that I was going to be going into exchange traded markets, knowing that these are much more with much deeper liquidity than what I'm used to, knowing that the finding an edge in those markets is much more difficult. I knew that I needed to have some way of systematizing my process to get the emotions under control. And so that's really been the process of this year is you know, getting a system down that I'm comfortable with. It's still evolving, and interestingly, I really appreciated presenting last week at the meetup, because the follow-on discussions afterwards got me thinking of a few other things. Did you think about this? Did you think about that? Yeah. And that's something that's missing right now from my trading, actually, is that I was in one extreme for the last 11 years where I'm in a very, very social environment on a trading floor where it's very noisy. You're constantly interacting with other traders, who being at home alone. And when I think of, you know, a lot of retail traders home alone trying to do this, my God, it's a very tough plight. It's a hard slog.
Yeah, exactly. And that makes me think about the stories that I think all of us heard in the past about when, you know, floor traders, you know, on the NYC or in the pits of Chicago, as that migration happened from, you know, kind of being on the floor to having to be, you know, kind of off, you know, using just the screens and being off the floor. Yeah. A lot of those traders, they lost a lot of informational flow, right? Because you were so used to being social traders and being around the pits and hearing the noise. You feel that too? I guess you were kind of tied to that squat box, so I'm sure you must have also had some cues that you'd always take off that were verbal, right? So
definitely. Yeah. I mean, you already. It's funny because even when you feel it, I mean, just to give you an idea, when there's a transition in a market, when a market's going through like an intraday reversal, right?
Yeah.
Generally what happens is you have sellers who are not really sellers. They're just trying to get filled on the bid. And so they're putting weight on the screen, but you see it and you know it because you know that there's a broker behind it. He's pushing that price. Yeah. He's trying to get it down onto, get the bid filled. And it's not getting filled. And all of a sudden there's a second bid that creeps up. And then someone's looking for offer. Someone's checking the offer. You know, and maybe I'm sitting a little bit behind the screen on the offer side, you know, can you improve your offer? This sort of thing. And so there's this dynamic that, you know, where 10 minutes earlier, the brokers were just screaming to get bids sold and they aren't getting sold. And all of a sudden they're looking for offers and a couple of these offers trying to push it down onto the bid are not there anymore. They start pulling back. Yeah. And then bing, 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 bing. And then then it can get quite violent on a reversal like that. And it's very, it's very verbal, very vocal, right? Yeah. And you don't feel that obviously on a screen.
Right, exactly. So maybe can you characterize like what's kind of been your transition then? How do you kind of, do you try to fill that void now that you're kind of off, you know, you're using just the screen now? Or do you just kind of shifted your trading so that, you know, you just changed the way you've traded?
I think the biggest shift for me has been in the way that I trade.
Yeah.
And I think in the past, I mean, I've always worked with models in one way or another. Yeah. But I was always a little bit discretionary along the way. And now I find that I have to lean more and more towards a more systematic approach because I just see that I don't have the leaning on. And I think that I mean, it's interesting because I'm always trying to work on self-improvement along the way. And I see that trading psychology is my biggest challenge by far. And the one thing that I wrote down yesterday was I need to find some way to socialize my trading activity, in the sense that I need to be more involved. So, for example, like last week's meetup is a prime example of a venue that allows me to talk with other traders and see what they're seeing maybe differently than me. It's reading sentiment, it's reading different factors and I need to find some way of doing that on a daily basis.
Yeah. So maybe you can share then, like, what is your trading approach now? So it's obviously screen based. It's you trade on an exchange. What's kind of your approach? What's your methodology?
So my method is, if I had to broadly categorize it, it would be statistical arbitrage. Okay. So in the sense that it's, I'm working only with one model, with a mean reversion model, which means that it's kind of the counterpoint to trend following systems. Yeah. Although there is a trend following element to what I'm doing. Basically the premise is that, if I look at the markets that I trade, I'm trying to find a market where reversion to an average price over time is common, where there might be drift, but there's no strong trends that you don't expect, for example, the euro dollar to triple in value over the next 12 months. Right. Versus a penny stock. Exactly. I expect it to sit in a range. It's going to be somewhere between whatever, maybe 110 and 120. And even if it goes above and beyond that range, I don't care really. That's more the system that will take over at that point. Yeah. But yeah, so it's definitely it's a very slow process. It's trading that requires a lot of patience. Okay. How do you identify the right kind of markets for that system? So how, obviously you can use a bit of logic and say, yeah, I probably shouldn't apply that to penny stocks, but do you do any kind of like quantitative work that allows you to say, all right, these kind of markets, they're kind of range bound? Is there a way that you can identify that you use, or any thoughts on that? I'm looking at a few different systems for the moment to pre-select. So what I've done currently is I've built a base model, which is let's say my live trading model that I use on a daily basis. Yeah. But what I'm working on now is to pre-select the markets, as you said, to basically avoid markets that are likely to trend. How would I put it? That for which the statistical approach doesn't work. Okay. Intuitively, just by loading the model up into the platform, I can already just visually see when I see. I work a lot with percentile deviations. Okay. And if I see percentile deviations that are way too close to the line, so meaning my mean price, then I know that there's a skew in the market. And it's very pronounced. So if I take, like, for example, the one example I used last week at the presentation was the S&P 500. Right. Because of the long-term skew of that market, it's changing now, of course. Interestingly, now the model might start to actually work with S&P, depending on where we go in the next couple months. But because of the long pronounced trend, any sort of statistical deviations from mean are skewed. And then that's what I can't use the model. Okay. And how many markets do you trade now with that model? So currently I'm working with 11 currency crosses and gold. Okay. And what I'm looking, probably very quickly, probably in January already, I'll be adding commodity time spreads. Okay. So for example, December, sort of the classic example is calendar spread on oil. So deck. So December 2019 versus 2020, for example. Those are relatively stable spreads that drift up and down based on a combination of factors, but the model handles those variations reasonably well. Okay. And I think I recall you saying at the presentation last week that your model generates daily signals, right? So it's using daily data or daily close data, and then you're making your entry decisions based off that. Correct. Yeah.
Okay.
Yes.
Yeah. So so when you try to model this data, is there like a standard look back period that you look where you look back to the past, so you'll look at the SPY and say, all right, that's, it's kind of a trending market. Is it like a 365-day look back period, or is it like a 6-month thing? What are you looking at in terms of the amount of data you look back on to make sure that it's fitting in the model's, sweet spot?
Basically, depending on the model parameter, I'm either looking back 50, 200, or 400 days.
Okay.
And so the 400-day parameters are really the long-term stable parameters that don't move much, that I don't expect to move much, and I need to keep those relatively stable for back testing purposes as well, because I need to make sure that what I'm working with is not a moving target.
Right.
Whereas the 200s and the 50s are more for things that need to capture more dynamic shifts in markets.
Okay. And I think, you mentioned something last week, and I really liked what you said about, one of the reasons for creating your trading system. You already talked about a bit already about, removing some of the emotion out of it. But I recall you talked about how, you wanted to really design a system that kind of fit your life, right? Versus having your life fit your trading, so to speak. Maybe you could talk a little bit more about that and the importance of maybe, setting goals for your trading system, right?
Yeah, no, definitely. And it's interesting because I find with markets, and this is it's been my assertion for a long time, that if you don't know what you want to get out of the market to start with, the market's going to feed off of your emotions, and you're going to end up doing what the market makes your emotions happiest with, let's say, or gives you the biggest highs and lows, let's say. Yeah. That's been my feeling, and I've seen it time and time again on the trading floor as well, where some people just get into bad habits that are driven by the market, not driven by rational, cool-headed thinking. I find that with a systematic approach, it suits my style for, how would I put it? There's let me put it this way. If I take the two extremes, if I take like pure discretionary versus a pure systematic approach, I find that there's nothing wrong with discretionary trading. I did it for a long time as well, but there's an element of ego that comes with it, unfortunately for me. And part of it is wanting to be right. Yeah. So when I'm defining entry, stops, and exits, there's an element of wanting to be right about those numbers. It's not coming from a model. And implicitly, there's a bit of a bullish and bearish bias that creeps into that. Mm-hmm. And I find that, at least the way that I'm trading now, I'm much more agnostic towards those elements. Yeah. So the first reason why I trade systematically is to manage my own emotions. It's been something that I've struggled with for a long time. And I feel much more zen waking up in the morning, especially with the way the system is set up. As you mentioned earlier, I take basically my trading session happens at the close. I avoid looking at screens during the day, intraday. That could change with time. I see that there's parts of the system that might be more conducive to day trading. Okay. But that's something I'd have to probably look at a little bit later. And it also fits my, there's two elements. It fits sort of I like math and I like statistics and these sorts of things. So it fits my persona well. And secondly, as I've mentioned, I have this mantra that I keep repeating: time, travel, trade. And I want to have time for friends and family. Mm-hmm. I want to be able to travel and see things. And my view is trading is what paves the way to doing that. Yeah.
That's a really good point there. Really some fine wisdom around some of those ideas. I think you really struck a chord for me anyways. It's like, I know I've seen it with myself and other traders that, it's a lot of people bring an element of neediness to the market, right? If you show up with that kind of neediness, whether the neediness of entertainment or you need to, or you need to make money or any kind of neediness, it's just like you bringing in that type of neediness in any type of relationship. It usually doesn't play out well, right? The people don't like needy people. The
Exactly.
markets don't like needy
That's
traders.
very well put.
Yeah. So yeah, that level of neediness, whether it's the entertainment value or because you want to escape the boredom or whatever it is, it's probably the wrong place to look for that outlet. So
Yeah, exactly.
I like that your approach. So what do you like most about the trading style you've developed nowadays? So it sounds like you have more time and more time to play with. You have more control of your emotions. What else are things that you most like about your trading style now, and maybe what do you least like about your new method or the current method you're using?
I think that the likes, it gives me, at least my approach right now. I'm not working in a company. I mean that could change, of course, with time, but there's this autonomy that I have right now.
Yeah.
So the ability to take an idea and go with it, right? And I like doing that. It's that's one of the things that's really kept me in trading for 20 years has been this idea that you can see that there's this macro picture that's happening outside and find your way into it somehow through markets and express that through trading. And I find that fantastic. And so there's the autonomy and the creativity that comes with it. That's what I love about this. With trading, it's a very creative job. For me, anyways, that's the way I approach it. Anyways, I like the fact that markets do change. I like the fact that edges do break down after a while. You need to sharpen old knives or sharpen new knives, and find a different way to attack a market.
Yeah,
that's great. The dislikes I have right now. My biggest dislike is the solitude that I have right now relative to what I had on a trading floor, definitely. Yeah. And related to that solitude is battling my emotions. I have a harder time dealing with my emotions. To give you an idea, so I mentioned earlier how on the trading floor where I was, there's sort of this senior-junior mentorship. And even as a senior trader, I find just sitting next to someone and talking through the idea, it brings that, it brings you out of the amygdala gland where you're, fight or flight, and takes you back into the neocortex. Okay, let's think this through a bit. What are we trying to do? Because I can't count how many times there's been on a screen. The screen is something's happening on screen, and I look at the guy next to me, the person I'm trading with. I say every bone in my body wants to hit every bit on the screen, and I just can't. I have to sit here and wait and watch. Yeah, and it's good to have that second check on the emotions, and that's something I'm missing, I'm for sure.
Absolutely. You ever considered maybe mentoring some other junior trader, just so that it gives you that opportunity to continue to outside of your head, but at the same time share your wisdom as well, impart some of your wisdom?
Yeah, no, definitely. And in fact, there's been let's say the initial ground for that has been laid for one of the other participants of the Montreal Traders group.
Cool.
And so I've been working with him. We've met up 3-4 times.
Yeah.
And it's interesting because just by meeting those 3-4 times, anytime I meet up with him, we come across each other, and we get to talk trading, and I see the things that he's thinking about, right? And I enjoy that, actually.
Yeah. Yeah. I really find, that's why I find the meetup so empowering, is that whether or not I present or not, just being around the traders, and especially when I present, it forces me to take the material that I know, the concepts that I know, and forces me to own them in a way that I don't own them before, right? So if I'm going to go up there and present something and share my ideas, then I really need to understand those ideas, and really, I have to be living them, not just understand them from a cognitive perspective, but I need to be able to be living them from an experiential perspective, so that I'm not coming off as a hypocrite. So I think it's a very empowering kind of thing when we do these meetups and we have guys like yourself, share ideas. It turns out that we end up getting better ourselves, right?
Absolutely. I really I can't emphasize enough how much those last week, just preparing for the presentation, it really forced me to sharpen the knives and say, okay, how iron sharpens iron. Okay, make sure that I've got a presentation that's iron, that's airtight, you know.
Yeah. Yeah. And you had some really fantastic, points in your presentation. Maybe talk about one, I had written down one of your bullet points, and I think we had some good discussion at the meetup around this idea was around, as it pertains to systems, waiting for signal completion and the importance of, waiting for that signal to kind of close out before taking the trade and jumping into it. So can you just expand on that kind of idea, the importance of that idea?
Yeah, no, definitely. It's something that I've struggled with on a few occasions, especially over the summer when markets are going sideways.
Yeah.
And you start to see something that's happening. And basically the way that my model's set up is that I'm generating the signals and they're only valid at the close.
Mm.
So you need to sit there and wait for the candle to complete.
Yeah.
And so that means you wait for the high, the low, and the close, right? And what happens is that the model is already on, at least the way I have it programmed, it's already generating the next day's signal, right? Yeah. Which is 24 hours away. I shouldn't be looking at it, but sometimes you're biased. Oh, look, tomorrow, if we're at the same level tomorrow, it's bullish or it's bearish, right?
Yeah.
And time and time again, I've seen the market put things back into perspective and say, no, you have to wait for the signal close, trust the model, and stick with it. And that's very, it's tough, but it's also, I think, important for back testing and also for checking your own results afterwards.
Mm-hmm.
If you start to, if you're trading a system and it's a bit dishonest to say, well, yeah, the system did this, but I actually traded like that.
Yeah.
So
yeah.
You there's a style drift that happens.
Yeah. So it's tough, right? Because you have this urge, like you said, to kind of front run the system sometimes because in your head, you're already a couple steps ahead and thinking, okay, it's going to close at this level. And so why don't I just get in now? It's going to get a better price.
And it comes back to the ego. The ego wants to be right. The ego sees what's happening. It's like, I see it. The model isn't confirmed it yet, but I see it already.
Yeah. And so in your experience, when you front run the signal, is it usually a positive outcome or a negative outcome?
Negative.
Negative.
8 out of 10 times negative.
8 out of 10, right? But the other 2 times make it worth it, right? Yeah, I think that's the truth for most people as well. Is that you front run the model, and usually over time, the model's going to beat you. But I think you brought up something interesting there because, in a way, one way you said, okay, trading the system in a kind of systematic fashion has removed some of the emotion, but then you also kind of said that trading the system is still emotional. So I think a lot of people think, well, if I just get my trade ideas into some sort of strategy or algo or quantitative fashion or system, then that should just remove the emotions from the trading. But you're saying hasn't done that for you.
No, and I think where things go a little bit go awry is in periods of drawdown. So when things are going fine, obviously, or even let's say break even, I'm fine with that. But it's when the periods of drawdown start to happen, and you start to second guess the system, and you see what's happening, and then you start to question whether you need to tweak some parameters and things like that. And that's where it can get a bit not dangerous, but I mean that's definitely where the emotions start to creep in.
Yeah.
And this is the thing that, and I'd mentioned it last week in the meetup as well, that I have this reminder on my phone that pops up every day at 7 a.m. to trust the model. I just need to put faith in it and go with it. Obviously making enhancements, but I think the thing for me, I need to have like a real structural reason to make an improvement these days. There has to be something that I'm seeing that's happening, and it's looking at it in retrospect, really looking at my last 6 weeks trades and saying, okay, what has happened? Is this really identifying quantitatively what is going wrong? Yeah.
So that's a really good point. So when is obviously your system is tuned for a daily signal. When do you know then? And you just kind of touched on it, but when do you know when to kind of intervene and say, okay, I need to either turn off, put the system on pause, or I need to modify the system because it's not generating the results that I thought I was going to get, from the previous tests?
Yeah. I think for me that there's the one clue that I usually have is when there's I call it like a logical fallacy that happens. So there's a logic that the model is supposed to capture and that the market is supposed to represent, that the model is supposed to represent of the market. And I can find a counterexample. And I had an earlier version of the model. I saw this coming, and I couldn't figure out why is this. I'm following the signal, but there's something wrong with that signal, and I couldn't put my finger on it. And then I finally was looking at looking at a combination of the code and looking at just really. Sometimes you have to write these things down on a piece of pen and paper and do the calculation, see what is this calculation right. And it's more nuanced, and it's very tough for me to pinpoint exactly when and how to intervene on those things.
Yeah, because I think we've had this discussion before at the meetups, and people kind of want that firm answer, right? They're like, okay, well, it's pretty simple. Just after the system breaks for or this many days, or doesn't get this many, has this many failed trades, and just turn it off or fix it. But I don't think there is any clear-cut answer, right? It's not like, okay. But people want that certainty when it comes to quantitative trading, because they think that, oh yeah, it's quantitative. It should just be like a black or white answer. It should not to be either 1 or 0. But I think it's a nuance, just like everything else. It's kind of nuanced about when to step in, right?
Exactly, and I think it's something too where you see that markets obviously do transition from different states, and it can be either increased volatility. There's kind of parameters that are lying underneath the surface that we don't see.
Yeah.
I mean, I'm trading flat price. I'm not seeing other dynamics of the market, right?
Right. Yeah.
And then that's certainly something. I mean, we talked about VIX and things like that are underlying parameters that we're not. It can influence the way that you would trade S&P, for example, right? I mean,
right.
There's a regime shift in volatility, and you need to adjust the model accordingly.
Yeah. I think it's very fascinating that whole topic of quantitative trading, and because I see a lot of people getting into it because people try discretionary trading, and they, like you said, they struggle with the emotions that come with discretionary trading, and they just think that the grass looks so green over there when if I just go to the quantitative space and I just create an algo as the next step, that I can just get rid of the emotions and I'll just trade emotion free and everything will just be great. But I think the lesson here is that as human beings, emotions are baked into the cake, so to speak, right? We're going to have emotions regardless if we trade discretionarily or using the quantitative system. They'll just show up at different times, of course, but nonetheless, they're going to be there.
Absolutely. Yeah.
So how do you deal with the emotions? So when you have, that kind of struggle and you're like, okay, the environment or that we're currently in right now, it's generating some fake outs and it's causing me to take some losses in my system. What's your approach to begin to, catch yourself to say, okay, I'm kind of falling off the tracks here. How do you get back to zero and get centered again and have that faith in your system?
I think that there's probably, I attack it on different levels. One thing that I'm getting better and better disciplined with is doing things like meditation to just keep how would I put it? So that doing meditation and these sorts of things helps me identify when the emotion allows me to observe the emotions better. Yeah. As an observer, rather than being in the emotion itself.
Yeah.
So there's that, and I forgot I was going to say something else, but there's another element. Then obviously, I mean, risk management tends to kick in at that point as well, where I scale back. I mean, it happened now this last month where I was starting to scale up.
Yeah.
And the system took a couple of hits, and I could feel that I was not able to contain my emotions on a controlled basis, and so I just scaled back. Okay, look, I need to scale back a bit. Start from a more solid footing. And I think the thing for me is that with emotions, there's sort of this threshold of pain that we all kind of have. There's this numerical value that there's a numerical drawdown, whether it's 2% or 5%, whatever the number is, that things start to really be painful.
Yeah.
And obviously, it's better to just have the risk. I mean, I have my own risk management model on the side, but it's definitely something that that I take into account. There's a bit of a give and take between my risk management and my emotions. That's for sure.
Yeah, and just the importance of preserving not just your capital but your psychological capital, right?
Absolutely. Yeah. For me, they go hand in hand.
Yeah. Very, 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 very true. So, what do you think then are, as we're talking about some of the struggles and some of the hard emotions that come from trading, what do you think are some of the most common mistakes that, so quote unquote struggling traders kind of run into? Do you see any, like, as you talk to traders and you guys you've seen on the desk in the past, do you see some common mistakes that people make that tend to exacerbate their situations?
Yeah, definitely. I mean, if I look back at the biggest blowups that I've seen over the last 10 years, the principal candidate has been the ego. Most traders, they tend to either they oversize a market or try to bully a market. I mean, of course, I'm seeing it. That's the luxury of being in an OTC market is that you observe these things firsthand. You know that this trader has this certain style, and they're trying to run stops, or they're trying to do this, right?
Yeah.
And I'm just thinking of this one example of a trader who was a superhero one year, and the next year he went to zero and was fired.
Really?
And the turnaround was, how would I put it? In some of these organizations, not where I worked, definitely not where I worked, but in some of these other like trading houses, to use a bit of a rough expression, if you're doing well, they'll give you enough rope to hang yourself with, right?
Right.
And that's exactly what happened to this guy, right? And so he had a fantastic year. He got maybe, in my opinion, a bit lucky on the oil market for that year. He made a very good call on oil.
Yeah.
Made a lot of, 8-figure P&L, fantastic. And then the next year, they double up his capital, and then he starts swinging for the fences, and then that's when things go off the. You are given more capital, you have more VAR allocated to you, so then you get out of control, right?
Yeah.
That's where having and you'd mentioned this last week, having this beginner's mind, I think you'd said, or learner's mind, I forget how you phrased it. That's something that I've always tried to keep in check. I tend to be on the other side of these trades eventually, because I see what's happening and I'm like, okay, well, this guy's trying to sell it down to this point, and it's not going to, if it doesn't break past that point, then there's a good chance it's going to turn violently the other way.
Snap back, right? Yeah. So the idea, the ego.
Yeah.
The ego, huh? Yeah.
For me, it seems to be a big culprit.
Yeah. It seems
it's obviously there's system issues and things like that as well that come up.
Yeah.
But or system failure. Those are things that have happened but I find those things generally, if you're sharp, you catch those things fairly quickly. I mean, I remember we were using an option pricing model in 2005-06, and it was doing fantastically well. And we were like, there was these auction processes where we were winning these auctions at great fills, getting these things out into the market later. And I remember this one point, it was around Christmas 2006, and the model just broke down. And it was the market had gone through a shift in volatility. And although volatility is a parameter in the option pricing model, the way that we were skewing the pricing was wrong. And so then that caught us. But then you correct it very quickly.
Right. Interesting. So it kind of happened on the dime like that, or kind of slowly, the model slowly stopped working?
We felt it right away. We did the pricing, and then just intuitively the number felt high. It felt like we were bidding way too high for this. And then we got everything filled, and of course we were the
Yeah.
winner's curse in an auction.
Yeah, exactly. It's never a good feeling. It's like, that could be a problem. So let's shift a bit. So what do you think? Who or what ideas do you think have impacted you most on your trading?
I think on the ideas side, I was for a long time very enamored with fundamental analysis.
Okay.
So that was something that I would say that in my first 5 years of trading, I very rarely looked at technicals.
Okay.
So very much driven by fundamental analysis, and it's very much in the commodity. It's something that comes out of the commodity philosophy, is that there's a supply demand balance, and that over the long run, prices revert to these levels. And it's something that over time, especially as I moved into directional trading. So for my first 5 years, at the same time, I was also only trading spreads and options. So I was never really trading outright commodities. Yeah. And obviously, when you add the outright, so the directional view on commodities, it changes everything. And then all of a sudden, for me, then the technical approach gains credence. That's something that over that time changed for me a lot. So definitely since 2011, my trading style gravitated towards that. And in terms of who, because you'd asked who and what, I would say,
exactly.
In terms of people, I really appreciate, if there's two famous traders that I really appreciate is Ray Dalio and Paul Tudor Jones.
Yeah.
I find my view is that if interviews are rare, usually what they say is quite deep and profound.
Yeah.
If someone's going to be on Squawk Box on CNBC every week, it's just market noise. But I find with them, their approach over the long run is very, very interesting. They have very long-term solid track records. And just when you hear their thought process, the way that they approach markets, I think is something that I try to emulate.
Yeah, fantastic. Have you? I think you did mention it that in your presentation that you're a big fan of Dalio's latest book, Principles. You gave some great quotes from that book. How has that book influenced your process?
It's an interesting book to give a kind of my short synopsis of the book. It's divided into 3 parts. And so the first 100 pages more or less is super easy reading because it's basically him retelling his story of the past 30 years, which is fascinating to see all the markets that he's been involved with. I mean, he was at the forefront of developing the inflation protected securities, the dollar DXY, the dollar index futures. He's been in a lot of different things over that time period. So that's very fascinating, very quick read. I think I read it in 2.5 days.
Yeah.
And then you get to the middle part, and that's where things get a lot more challenging because it's talking about life lessons.
Yeah.
And that for me, I'm reading it very, 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 very slowly, and I go back and I reread it again very, very, very slowly.
Yeah.
And I find that each of those principles that he brings up there's so much wisdom, and you can see how it applies to trading very clearly.
Mm-hmm.
There's this process that you go through of improvement, and of course he was one of the earlier people to systematize their trading very early on, and even in the 80s, he was already programming a lot of the decision rules, and so that's something that I've been using a lot in my own process in model building.
Yeah. And one of the big lessons that I really liked from that book or took away from it wasn't really a lesson, but I just thought there was such a powerful truth to it. It was the story when he shared about his failures, right? And he was never shy about not trying to he wasn't trying to show that he was perfect, right? And he made many mistakes, and to the point where he'd was nearly out of business at one point early in his career because of his ego. Right? He talked about it about how his ego was really out of control, and that it caused him to have a horrendous drawdown. And he had to basically restart again because no one really wanted to be around him.
Yeah.
So really, really powerful stories from Dalio. One quick question. I want to take a quick step back because I just want to get one answer that I had, which I was curious about. So the platform, so the system that you designed, what platform is that running on? Do you do that in Python? Do you have your own running off your own code base, or are you doing using sort of off the shelf platform for your modeling and that kind of stuff?
So the initial model that when I was doing the development was in Python.
Okay.
And I was having issues because basically what I was using was Python querying Quandl database.
Okay, yeah.
And the problem was that the updates of the Quandl database happen quite late.
Mm-hmm.
Like I can't get closing prices at the close with Quandl.
Right.
And so interestingly enough, I was at one of your meetups earlier this year, and I saw someone had TradingView up on the screen. It might have been you actually. I don't know. And excuse me. And I saw that. I wrote it down. I went home and I checked it out. And so at that point, or no, maybe a month later, I switched over to TradingView.
Okay.
The Pine scripting language that's in there. I find it's nothing fancy, but it gets the job done. Sometimes you have to work a bit with the code to get what you want done, but it does it in a fairly clean way.
Right. So sure. So do you use the backtesting tool that's in that product, or you do the backtesting in outside of that in your own spreadsheets and that kind of stuff, or do you try using that stuff that's inside the trading?
I have tried the backtesting tool that's in there, and I find it. I don't want to be too critical, but I find it's not robust enough for what I'm trying to do.
Right.
So I'm looking for, and I just found actually as a follow up to last week's presentation, I've been introduced to a couple of other platforms that have better backtesting.
Yeah. The backtesting tool, I've tried it as well in TradingView, and it looks like it's it's still very new, so it looks like it needs to be a little more fleshed out, but not bad for someone who's kind of new to things, but certainly, like you said, doesn't have a lot. It's not that robust.
Exactly. Yeah,
cool. Exactly. I was very curious about that. So we're coming up on an hour already, so I'm having a lot of fun chatting, but maybe we should be more respectful of your time, so I'm going to start to close things down a bit. So what are your thoughts? You talked about Ray Dalio's book as a great book. It's Christmas right around the corner, and traders out there, if you want to, books are always a great gift. So Dale, you have any books that you'd recommend for traders as Christmas presents or just topical reading? Yeah,
I think, the three that I was thinking about this the other day, I think that the three trading books that I've come back to in different periods of time. So there's the new one for me is Principles, Ray Dalio. Sure. And I realize that it's not strictly speaking a trading book, but I find that the mental process is super important there.
Yeah.
Then there's the Reminiscence of a Stock Operator. I find it's a reference. It's really a classic.
Yeah.
And then a third one that I've looked at, or I've read, and it got handed around the trading floor is called Diary of a Professional Commodity Trader.
Oh, who's that? Brent? Yeah. Okay.
His style is purely discretionary. So there's big chunks of the book that I kind of gloss over, but his risk management is quite solid. And just his way of seeing markets, I think, is pretty. And what I also appreciated with him is that he's not trying to sell you some system, because it is a diary, and what I appreciate with it, it's very open with his gains and losses over that period.
Yeah,
and he talks through that process of and I find it gives me a good idea of what's a reasonable amount of trades to be doing per month, what's a reasonable amount of capital. I mean, there's the risk side of it. I think he certainly shaped influenced me on some of his process. I don't use his parameters, but I'm definitely influenced by that.
Cool. Yeah, I remember reading that book a long time ago. I'll have to try to find that again, because you're right. It was a good book, but I read it many years ago. But yeah, Reminiscence is another one. I tend to read that every year.
Yeah.
It's like one of those books that I gravitate back to every now and then. It's like, oh yeah, it's been a while since I read that book, and I pick it up again, and it feels like I'm reading, for the first time. There's always little new lessons that come out each time, right? You just pick up little things.
Absolutely. Yeah.
It feels like I pick up that book every time I have a bit of a lull. Like I feel like, oh, my trading's kind of getting a little bit, I kind of have a lull, and I pick the book up again. Like you said, that kind of fire, it kind of, ignites it again. So it's a great book. So to wrap things up then. So if people want to hear more from you, do you have any social media that you put out there? Or are you active on the social media side? Or if people want to find you and see your perspectives, if you share them?
For the moment, I'm not. And it's interesting because it's interesting you asked that, because one of the things I wrote down yesterday was socialize my trading. And I think that's something that would probably help as well. I don't, for the moment, I don't blog. I don't do anything yet. But it's something that I should probably look into.
Not a problem, yeah. Maybe not, because I find the social media it's a lot of times it's just noise.
I'm always afraid of this. Yeah, that's part of what's held me back. Is I'm afraid of the distractions that it might cause.
Yeah, exactly. You don't need internet trolls coming after you. So, but yeah, of course, if you're in the Montreal area, Dale comes out to the meetups regularly. So if you're in Montreal, drop in at one of our meetups and you'll get a chance to meet Dale in person, which is a lot better than just chatting via Twitter, in my opinion. Anyway, so Dale, I want to thank you once again for last week's presentation. I want to thank you for today's chat. I thought it was fascinating once again. I really am grateful that you're part of a community and that you're so willing to share your experiences and ideas. So thanks once again.
Well, thank you very much, Houston. I really appreciate the time. Thank you.
It's a pleasure, man. And we'll talk again soon, okay?
All right. Thanks.
All right. Take care.
Okay, thank you. Bye.